The reason that the wave to passive is really here to stay, I mean, whether there'll be some little travels up or down over time, big picture, I gave a talk at Google a few years ago and I started it this way. Even Warren Buffett says most people should just index. And then I said, I agree with him. And then I left. No, then I said, but then again, Warren Buffett doesn't index and neither do I. How come? And so there's a big dichotomy. If you don't know what you're doing, the safest thing to do is to index. Investing in stocks is really about valuing businesses and try to buy them at a discount. Your other alternative, if you can't do that, your other alternative is to find a manager who has a good process and sticking with that. But I wrote a book a number of years ago, I think in 2011, called The Big Secret. And my line is always that it's still a big secret because no one bought that book. But in it, I talked about the best performing mutual fund for the period 2000 to 2010. And that fund was up 18% a year. But the average investor in that fund, the market was flat during that decade, so up 18% a year was pretty good. The average investor in that fund managed to lose 11% a year on a dollar-weighted basis by moving in and out at all the wrong times. After the market went up, people piled in. After the fund outperformed, they piled in. After the market went down, they piled out. Or after the fund underperformed, they piled out and turned that 18% annual gain into an 11% dollar-weighted loss. And that's just the way people are. If you don't know what the manager is doing, you look at past returns. But there's been plenty of studies showing the last 1, 3, 5 years don't have much to do with the next 1, 3, 5. And really what you're supposed to do is look at process and finding a good manager and assessing that. Most people don't have that skill set either. I think the good news is that if most people just index, if you're a stock picker and actually do the work, there's less competition. And I think that'll be helpful as a stock picker long term. But the active management business will still continue to be threatened.
Even if investors understand what the manager's doing, at least they're investing in a fund and they think they do, but even if they understand that going in, they just can't stand it when he underperforms or when a fund underperforms. So it's not even as if you don't understand the manager in the process. It's that psychologically, right, from a behavioral finance point of view, you can't take the pain. Is that that's just the way it is?
Sure.
With us. Understand human nature.
With everyone. I mean, absolutely. The other study I wrote up in the same book was about the best performing institutional funds for the same decade, looking at the top quartile managers. Half of them, 47%, spent at least 3 of those 10 years, even though they ended up with the best 10-year record, they spent at least 3 of those years in the bottom decile. Bottom 10%. So it's very painful, but to beat the market, you have to do something different than the market. Your returns are going to zig and zag differently. And even if you're a manager who can stick with your process, and that's who ends up winning at the end, very hard to get your clients to believe in you after you've had a couple bad years.
It's also hard to keep your job unless you happen to be running your own shop.
There's, as you mentioned, there are behavioral problems and there are really agency problems. Even if you're at a large endowment, I sat on the board of university endowments. But think of the difficulty of the allocators at that endowment. While university is effectively a perpetuity, there's no pension that you have to pay out. There's nobody retiring. It's basically a perpetuity. Should have the longest time horizon of anyone. But there's a gentleman or a woman who allocates to U.S. equity managers or private equity managers or bond managers or whatever it is. And they're viewed over a 3-year time horizon. It doesn't mean they lose their jobs, but they'd like to win. They'd like to beat their benchmark over that 3-year period. And as I always say, no one really gets fired, but no one throws you a parade either if you haven't beaten your benchmark. So there's an agency problem even in the funds that should have the longest time horizon. So once again, I view that as good news for stock pickers because if other people aren't patient, and you can be, it's really a great way to make money. I read a great book this past summer. It's called Astroball. And it was really written by a Sports Illustrated, it's sort of a next generation Moneyball book. But it talked about the Houston Astros and how in 2014 they were the last place, they were the worst team in baseball. And a Sports Illustrated writer wrote a story about them. He thought it would be buried in the magazine saying that I think seriously that the Astros were going to be the World Series champions in 2017.
Based on
what they were doing. And so in 2014, actually, to their credit, Sports Illustrated put on their cover Houston Astros 2017 World Series champions. And of course, they won the World Series in 2017, going from the worst team to the best team. And what did they do? They took a long-time horizon. So usually most teams are trying to win now, and they're trying to get players and playing their best players right now and trying to get the best players right now so they can win the most games. But if your focus is only on doing really well 3 years from now, well, you're going to start playing some of the players that you're trying to develop.
Right.
And you're only going to try to get people who are still going to be with you 3 years from now. And so you make all your decisions based on the long term. And that really worked out for them. And I think it's the same thing in investing. Most people are judged over very short periods of time. And so that's how many managers are, you don't want to pick stocks that of companies that aren't going to do well in the next few years. But sometimes those are the best prospects, thereafter, once they've gone through the tough period. That's why you're getting the bargain. And so if you're actually focused on what's going to happen 3-4 years from now, you're kind of alone. And that's called time arbitrage, just waiting for the market to agree with you. What happens in the short term could be very ugly. Time horizons are actually shrinking. They're not growing. And so as much as I said unkind things about active management, the opportunity set is really quite nice for people who view stocks as ownership shares of businesses that they simply value and try to buy at a discount. It sounds ridiculously simple, but it'll be a nice world for stock pickers.
We've had a 10-year bull market. And, we see all sorts of signs of, corporate earnings are starting to slow down. The economy is starting to slow down. We've got a, global slowdown. Aren't we possibly entering an era where the stock market is not going to do that well?
We've been valuing the stocks in the S&P 500, and we can do that based on the way that we value businesses. Based on varying measures of absolute and relative value that we've always used. And we can go back to 1990 where we have good data. So where do we stand today versus the last 28 years? And doing it that way right now, based on our data, we sit in the 16th percentile towards expensive over the last 28 years. That means the market has been cheaper 84% of the time and more expensive 16% of the time. And this isn't a prediction, but what we can do is go back in time and say from the 16th percentile in the past, what's happened over the next year or two.
What has happened?
Year forward returns have averaged about 4 or 5% a year going forward, and 9 to 11 over the next 2 years. So not terrible, not negative, even though we're above average in valuation. Market averaged about 9 or 10% returns during the 28 years we looked at, so certainly subnormal, but not negative. Of course, your opportunity set is not just what's in front of you today, but what might be in front of you 9 or 12 months from now or even 2 years from now. So should you be patient and hope for better opportunities? And that one I can't help you with. I can tell you for the Russell 2000, we're in the 4th percentile. That's stock number 1,001 through 3,000 in market cap.
So it's 96% of the time it's been cheaper.
Yes,
in the Russell
very,
2000.
very expensive. Small cap stocks, the Russell 2000, super expensive. In the 4th percentile, only been more expensive 4% of the time over the last 28 years, been cheaper 96% of the time. When it's been here in the past, year forward returns have been -2 to -4%.
Oh, interesting.
So a totally different story. And, like we do, we short stocks.
Right.
So we don't short the index, we short the most expensive stocks in that expensive
in the
index.
Russell 2000.
So hopefully our opportunity set is pretty nice on the short side in the small caps. They've been hurting us for a little while. Luckily we've been making money on the long side, but on the short side, those have been hurting us for quite a while, but we're short the most expensive stocks in a very expensive index. So we think our opportunity set is really good there and much, much greater than in the large cap space. So when we go putting together a portfolio now, we're finding the relative bargains more in the large cap space, even though they've done quite well, and the most expensive stocks in the small cap space.